Hello and good afternoon, everyone. My name is Alum, and I'm a proud 2017 York grad, a young alumni ambassador with York, and a senior financial analyst with Moneris. I want to extend a warm welcome to everyone who has taken the time to join us for today's GRADitude session titled First Time Home Buyers. The GRADitude program provides recent graduates with the opportunity to learn and connect with fellow alumni, and especially warm welcome to this year's grads. We officially welcome you to our 350,000 person extended family. Before we start today's session, I will share York's land acknowledgement. Although we aren't all in the same location, we recognize many Indigenous nations have a long-standing relationship with the territories upon which York University campuses are located that precede the establishment of York University. York acknowledges its presence on the traditional territory of many Indigenous nations. The area known as Takaranto has been caretaken by the Anishinaabe Nation and Haudenosaunee Confederacy and the Huron-Wendat. It is now home to many First Nation, Inuit, and Métis communities. We acknowledge the current treaty holders, the Mississaugas of the Credit First Nation. This territory is subject of the Dish with One Spoon, Wampum Belt Covenant, an agreement to peaceably share and care for the Great Lakes region. If at any time you need help with this experience or have questions about the content, feel free to click on the Q&A button on the bottom of your screen. Our team is ready to help you. Today's session is brought to you by the Alumni Engagement Team at York University in partnership with our friends at TD Insurance. TD Insurance has been a long-time affinity partner of York, providing alumni with preferred rates on car and home insurance, and we thank them for supporting our fall learning GRADitude sessions. We also recognize and thank TD Bank for preparing this session's content, along with the representatives who have joined us to present today. You each came here for a reason. We want to do our best to provide you with helpful advice and insight. We'd like to know, what do you hope to get out of this session today? Using the Q&A function, please take a moment to type your response now. We'll take a moment to share our thoughts about what do we hope to get out of this session today. Some of the responses that have started coming in is understanding the paperwork to buy the first home, what are the first steps to buy a home, and of those sorts. What impact does the credit score have on a mortgage applications? Feel free to continue to provide more responses, and we will try to address some of these questions and some of these interests that people have. Great, and thank you for participating. Really appreciate it. Now I'm honored to introduce you to our alumni speakers, Michele Da Silva, who is a branch manager with the TD Canada Trust, leading a group of financial professionals and has worked in the financial industry for over 16 years. She has a degree in human resource management from York and holds both IFIC and BCO designations. We are also joined by Stefania Giorgio, who is a branch manager with TD Canada Trust and has worked with the company for the last 16 years. She has a bachelor's degree in psychology from York, is an advocate for financial literacy, and continues to take on opportunities to share her financial knowledge. Michele, Stefania, thank you for joining us today, and I'll pass on the stage to you to take it away.
Lam, thank you so much for that introduction. Thank you everybody for having us here today. I will jump right into the session. I'm just going to share my screen and we can all follow along. So welcome to First Time Homebuyers. Let's answer some of those questions. And if you guys do have any other questions at the end, we will get to them absolutely. So first and foremost, before you make an offer, okay? So should I rent or should I buy? So this is a common question that people ask themselves. There's different perks that come with both. Renting, some people say, you know, you're not stuck in one area. You can always change. You can give your notice and move to another place if where you are doesn't fit your needs at the time. Other people talk about, being able to rent and then maybe putting some money aside and investing in different ways rather than just investing in properties. They're investing in other options, so the stock market or whatever else it might be. So there really are two different ways to do this. Now, the reality is, though, when you buy, it comes with a lot of benefits. First of all, you're owning your own asset. There is the pride of the ownership, so it's yours, so you want to take care of it. There is definitely potential for increasing in value. All we have to do is look at the markets today. And then there's tax credit and tax deductions that you can get when you do own a home. So if you do any environmentally friendly renovations or upgrades, there's lots of different tax credits that the government does offer when you own your own home. So you really have to sit and ask yourself, okay, so is the renting going to be more beneficial for me? Do I want that freedom to just pick up and go whenever I want, less responsibilities? Or do I want to own, and do I want to make it mine? So that's the first question you're definitely going to want to ask yourself. Then, am I ready to buy a home? So buying a home is obviously a really, really big commitment. Not only do you have to come up with your down payment, but you have to prepare yourself for your unexpected expenses. So there's certain things that can happen with a home that can't wait, and you have to be prepared to pay for them immediately. So a leaky roof or a furnace breaks, that's stuff that has to get taken care of immediately. So you want to make sure that you always have that extra little cushion on the side when you are a homeowner, so that you are prepared for those unexpected expenses, okay? The other thing, again, is you don't have that same flexibility to just pick up and move so easily. Maybe it's not a seller's market. Maybe you're not going to get what you're asking for when you sell your home. So those are things that you really, really need to think about, okay? So you have to commit to that area. So then there's questions you want to ask yourself before buying a home, okay? So first of all, where do I want to live? Do I want to be close to family, close to work? Am I prepared to make this commute? These are all things you want to ask yourself. What neighborhoods do I like? So do I want to stay in the city? Do I want more of the suburb? Where do I see myself? You have to narrow it down. School system. So school system, is it somewhere where I'd want to raise my kids? Maybe I don't have kids now, but it's something that I want to think of in the future. So am I in the right district that I want to be? Am I close to transit? Am I close to shopping? Am I close to the things that matter most to me? Is it easy for me to navigate and get there? And then there's what type of property do I want? So do I want a house? Do I want a condo? Different perks come with both. Condo, very easy, lock your door and go. If you're one to, frequently vacation, or you don't want to deal with maintaining the outside of a home or doing that kind of stuff, condo is a great option to own a property while not having to worry about the maintenance of the property. Having a house, on the other hand, you have a yard, you have a driveway, a backyard, a basement, a garage. So, but there's also an upkeep that comes with owning a property, a house. So these are questions that you really, really have to ask yourself and decide what's best for you and where you're at on your situation. And then do you want an existing property or do you want a new build, right? Do you want something that turnkey, you just walk in, ready to move in, good to go? Are you looking to do some renovations? Maybe you want to make it your own. With existing properties, you usually have to do some upgrades of some sort. So is that something you're prepared to do? So before you make any final decisions, this is definitely some questions you need to ask yourself to really determine and narrow down what's going to be best suited for you. So now, how much can you afford? Now, this is where your budget is really key, okay? You want to make sure that you're using a mortgage calculator to get an idea of what your payments are going to look like. If you've done proper research, once you've narrowed down the area, you should know roughly what your property taxes will look like and any other expenses, your water, your heating and whatnot. So you should have a ballpark of what that amount would look like. One thing I do like to recommend is the minute you start thinking about, hey, do I want to buy a house? Is I like the tip of if you know what your budget is going to be and you know roughly what it's going to cost you, start saving that money now, put it aside immediately. So if you know to maintain a home between my mortgage payment and all the additional expenses that come with it, I'm going to need $2,200, $2,500. Start putting that money aside now so you can see, okay, this is something that I can absolutely do. Don't dip into that money, and then you'll be able to use that as well for the purchase of the property. But it'll give you an idea of what that impact is going to feel like when you do buy a property and that money is being dished out of your paycheck every month, right, to maintain having that home. So this is an example of a budget. So again, you're going to factor in your mortgage payments, what that's going to look like. You're going to factor in your property taxes, condo fees if that's the case, home insurance, utilities, and like I said before, definitely going to need an emergency fund just in case you need something. Now, again, use a mortgage calculator to get an idea of what your payment would look like, but a general rule of thumb, give or take, is usually about $500 for every 100,000 that you're going to borrow. So that'll give you a good idea of roughly what that mortgage payment can look like. But definitely go in. TD's got a great mortgage payment calculator that you can use where you can input all your numbers and it'll tell you roughly what your monthly payment will look like. So now we have down payments. So in order to purchase a property, you have to put some money down beforehand. Now you can put as little as 5% on the first 500,000 that you borrow. And you can put as much as you want, but if you put over 20%, you don't have to pay CMHC. So it's the mortgage default insurance that is charged. It's a certain percentage on anything you put less than 20% of the purchase price of the property. So that's something really important to consider because it's also going to get factored into your payments as well. Again, TD's got a great down payment calculator. So it'll give you an idea of how much you need to save each month and how you can get to that goal. But so remember, 5% minimum for the first 100,000, 10% for anything over 500,000. And if you don't want to pay the CMHC, you have to ensure you're putting at least 20% down of the purchase price, okay? There's also rebates that you get for down payments. Depending on if you're a first-time home buyer, there's land transfer tax rebate. Again, this is something I would recommend you would talk to your accountant or your lawyer, and they'll give you an idea of what it would look like for your specific situation. And there's also many different calculators online that can help you. So your down payments can come from anywhere. It can come from savings. It can come from a gift from a family. Most banks need a gift letter. You can withdraw from your RSPs, so you can take up to $35,000 from your RSPs, tax-free and interest-free, and then it would have to be repaid within the next 15 years, okay? The other thing you have to consider besides your down payment is all the additional fees that come with purchasing a property. So you're going to need a lawyer, so there's definitely going to be legal fees involved. Any closing costs, there's going to be moving fees for when you do move your things there. Land transfer tax, as I mentioned, this is another thing to really keep in mind. So it's a certain percentage of the purchase price of the property. And something really key to consider and to know is when you purchase in the city of Toronto, so Toronto exactly, you're actually paying 2 land transfer taxes. Ontario has their land transfer tax and Toronto has its own land transfer tax. So it's a double. But it's a certain percentage on the purchase price. I can't give you a number. Again, tons of calculators online that can give you what that number would look like. And there are some rebates if you're a first-time home buyer when it comes to the land transfer tax. But that is something that I would recommend you speak with your lawyer or your accountant to get what your definitive number would look like in that sense. Other fees that you have to consider is home inspection, and any renovations that need to be done as soon as you buy that property. So these are all things that you want to consider when you are buying a property. They ballpark it usually around to 1.5% to 4%. Always better to stay on the higher side. Better to be over than under. Okay. So now buying a home. So what is a mortgage? So a mortgage is a loan that the bank lends to you in order to help you purchase your property. Your mortgage you have 30 years to pay off your mortgage. We call it an amortization. And within that amortization, what happens is you take on different terms to within these 30 years. So your terms can be, anywhere from 1 year to 5 years to plus, but generally people don't go for more than 5 years because there's a lot of uncertainty in there, right? So you'd be stuck within a term that if you needed to sell, if you needed to break it, the more that's left on the mortgage, you could potentially be paying a penalty, depending, because there's a lot of options too, if you have to go in and break a term. So again, your mortgage payment calculator will show you what those payments will look like. But it's important to kind of make a decision on what rates would I want to, entertain, what rates would work best for me. So we offer two types of rates. One is a fixed and one is a variable. So with a fixed rate, you decide, we say, okay, this is a 1 year rate, this is a 2 year rate, this is a 3 year, 4 year, whatever it is, depending on what you're planning to do with the property. So if I'm not leaving, I want to stay, I feel comfortable going with a 5 year, what's your 5 year rate? That will be your specific rate for that term that you lock into. That doesn't change. For that term, that amount of time, that's going to be your payments. A variable is slightly different in the sense that it's prime minus a number, so minus a certain percentage point. And the reason it's variable is because prime can actually change. So you run the risk or the benefit of prime going up or down. So if prime moves up, your rate will slowly go up, which means that more of the payment you are making on a monthly basis is going to go to interest rather than paying down your principal. But you also have the added benefits of prime potentially going down, which means more of your payment is going to go to principal rather than interest. So if you're the type of person that, doesn't like change, wants to know exactly what's happening on a regular basis, maybe fixed might be for you. If you know about the markets and you're comfortable in taking on a variable, sometimes people have done very, very well in a variable and have been able to pay off a lot of their principal by benefiting in that. So really important to know the two different types of rates we offer, which is the fixed and variable, and then knowing what kind of term you'd want to go into. The other thing, side note, even if you're in a mortgage and you decide to, move TD, we offer a lot of convenient ways to be able to port the mortgage with you to your new property if need be. So again, I would encourage you to talk to your advisor about what your options are if it does come to that. Okay, so getting pre-approved for mortgage. Very, very, very important process to the whole as part of the home buying process. This is going to tell you what you can afford. And it's really important that when you're shopping, and you're going out in your own budget and you're not looking at homes that are way out of your budget. Now, one thing I would tell you is this is also a key point of knowing what your day-to-day expenses are and knowing what your budget is. So when we look at a mortgage and we do a mortgage application, we take into account, your income, any existing debts you're paying, and what the costs of your new home will be. But there's other things that are factored into your budget that you need to know about. So if you have to pay $1,500 a month for daycare, it's really important that you take that into consideration in your budget. So while you might be pre-approved for a certain amount, you need to know if that monthly payment will actually work for you and your specific situation, or should you go a little bit lower and be more conservative. This is why first step in this entire process is always making a budget, because you need to know what your number is that works for you and your family. Okay, so once you have that, then you have your pre-approval in place. So why is a pre-approval so important? Pre-approvals, first of all, are really important because it tells you what you're looking for. You're not going completely out of your means, and then you're going to be surprised in the end of the day. You get the advantage of locking in an interest rate for up to 120 days. So even if the interest rates move while you're shopping around, you've still locked in what your rate is going to be, provided you buy within that time period, okay? The other thing to really remember is many realtors want you to have a pre-approval, because right now we really are in a very competitive housing market. So what happens is you might have numerous offers, but if you put a condition upon approval, mortgage approval. So sometimes people will say, I don't have a pre-approval yet. I need it conditioned. This way, if I don't get approved, I can get out of this deal. But another buyer puts it as no condition because they know that they're already approved for this amount, so they can go in with no condition. They're definitely going to get it before you. Most people they want to go with the easier transaction of it. So definitely make sure you have your pre-approval in place, knowing what you can afford and being confident in signing that deal, and knowing that that's going to be something that you can comfortably take on, okay? And then mortgage prepayment. So you buy your home, your mortgage starts, great. You know what your monthly payment is. It works in your budget. You've done all your homework. You know that everything works for you, but now you want to pay off your mortgage a little bit faster. TD, we're amazing. I'm not biased by any means, but we offer really a lot of great flexibility in your prepayment options. So you can actually double up to 100% of your payments without paying any additional fees on that or any additional interest on that. We also give you the option to pay down 15% of the original borrowed amount on your mortgage. So these are all different ways that you can put extra money down to your mortgage, and it goes all to principal, not to interest. So it's actually chipping away at your debt load as a whole. So TD gives a lot of options in those mortgage prepayment options. And then we give a lot of options if it comes down to you selling beforehand and what you can do. But again, I would advise you to talk to your mortgage advisor, and they will give you, more details of what you can do in your specific situation. Okay. So at this point, I'm going to pass it on to my colleague, Michele. And Michele, you can go ahead.
Hi, everyone. Thank you so much, Stefania. So now I'm going to go over who's going to be involved in your home buying adventure. So there are typically 4 different parties. So Stefania, if you want to go to the next screen. So the first one is your mortgage specialist. So typically, this is someone that you've probably already spoken to at your branch where you do your day-to-day banking. A mortgage specialist is ready to do the application for you. So Stefania mentioned the pre-approval process, and this can be done with them. So sometimes they're called financial advisors. Some banks call them mortgage specialists, but really what they're doing is they're looking to see how much you can qualify for, and then they're the individuals that are actually putting the applications through for you. So checking your credit history, your income, looking at giving you advice in terms of which product you should be going for. So is it a fixed or is it a variable? And then also sometimes they might put you in touch with other advisors who are better suited to maybe close your lines of credits or help you with some savings plans if you aren't quite at the point yet to make the purchase. After the mortgage specialist, we have your realtor. So how do you find a realtor? So word of mouth, referrals from friends and family, these are all great options. And a realtor is important because they're really the expert in helping you find a property. So typically you'll give them kind of an idea in terms of your price point because you've already gone to the bank to get your amount that you can qualify for. And they're going to narrow it down by neighborhood, by price point, what your family requires. And then they might even be able to send you listings. So you don't actually have to leave the comfort of your home, and you can do virtual tours. They could send you listings to your inbox, and you can have a kind of a sneak preview. They also help negotiate the purchase price. And then in terms of completing the actual agreement, they're the ones that put it together in terms of creating the offer, and they can communicate with the seller's realtor. Next, you have the home inspector. So typically a home inspection is done on a resale property. It costs anywhere between $400 and $600. And a home inspection is key because a home inspector might identify something you might not see on the surface. So you walk into a house, you fall in love with it, but you might miss that crack in the foundation, or you might not see that there's actually water leaking into the basement. So an inspection should be a condition on your offer to purchase, and it should be completed prior to finalizing the mortgage. And here it does mention also, even new homes should be inspected, even though you typically do a walk through the property with the builder when it's a builder home. If there's any problems or concerns identified, you can include this as a condition on the offer. So say, for example, going back to that roof is leaking. If you put an offer on a property, the seller has agreed to it, you do your home inspection, and the home inspector says, you know what, this roof is leaking, it needs to be repaired to avoid major damage, then you can put a condition in your offer for the seller to actually fix the roof, maybe at a cost to them, or it's really up to you in terms of what you decide with the seller, but you can add this onto your agreement and have it negotiated to be repaired prior to the closing of your home. And then lastly, your lawyer. So your real estate lawyer has a wide range of responsibilities. Essentially, when you put the offer, you're going to receive a purchase and sale agreement showing that you've entered a contract with the seller of the home. You're going to take this offer to your lawyer, and you're going to have them look it over and make sure there isn't any red flags, anything that kind of stands out. They're also going to assist in the transfer of the title. So they're the ones who are actually going to add your name onto the property and remove the previous seller's names. They also support in registering the mortgage. So if you get a mortgage with the bank, because you haven't paid 100% cash for the property, then they are actually responsible in also putting the mortgage and the lien that the bank will have against the mortgage on your property. They're also making sure that there's some AML compliance in terms of where the down payment came from, making sure that the mortgage is suitable for you as well. Sometimes they'll give you advice, but definitely your lawyer is a crucial piece. And like I said, through referrals from family and friends, Google searches, sometimes even your lawyer will be a referral from your realtor, or your home inspector will be a referral from your realtor as well. Definitely these areas work very closely with one another and know of each other in the business. So now let's close the deal. So finalizing your mortgage. So you've made the offer, it's time to finalize. So property details are added to the pre-approval. So in the very beginning, you would have gone to the bank, you would have completed a pre-approval application. In the pre-approval application, there's actually no property address that's listed. So when you've actually found a property, you need to go back to your banker and tell them the address. You need to show them the purchase and sale agreement, the contract that you've entered to purchase a property. And then we'll need to confirm where your down payment is coming from. So is it a gift? Is it coming from an existing property that you're selling? Is it coming from maybe family and friends? We're really looking at making sure we have all of the documents to support your down payment. The mortgage agreement is completed, and then we, as a bank, will let you know what your term, amortization, interest rate, and payments are, and then you sign. Once you sign, then we are able to send the legal documents to your lawyer. Once your lawyer receives the documents, then they're going to call you, and you're going to probably go in with a draft certified check to give them the remainder of the deposit or down payment, and then they'll be able to actually sign the final documents with you. Protecting your home. So there are two types of insurance. The first one is sometimes called fire insurance, but it's essentially home insurance. So it's required for anyone getting a mortgage. So the three key areas are structural coverage. So in the event that your house gets compromised, so a wall caves in, this will protect you in terms of the impact. Comprehensive coverage, so the contents of your home. So think about it, if you turn your house upside down, anything that falls out, that would be considered contents. And then liability coverage in the event of injury or death on the property. The second type of insurance is mortgage credit protection. So this is in the event that you become terminally ill or pass away, then the person who remains on title will actually have the benefit of having the mortgage balance paid off. So I'll give you an example. There are two individuals on a property. One might be diagnosed with cancer or have a heart attack or a stroke. They essentially could also survive the terminal illness, or if in the unfortunate event they do pass away, then the other individual on the mortgage will have the balance paid off at a premium. Okay. And then now that you're a homeowner, so just because you've gone through all of this tough stuff in terms of saving up for a deposit, a down payment, you've got your mortgage now, you're making your payments, doesn't mean the fun ends there. So you should really have essentially an emergency fund because home ownership can be expensive. There are things that sometimes happen. Shingles blow off your roof and you need to have your roof replaced. On a day like today where there's a lot of rain, maybe you have a leak in your basement and you're going to have to fix that. So really setting up a pre-authorized contribution into a savings account just to have a little bit of money in the event you need to make repairs is a great idea. Also, the first-time home buyer tax incentive. So Stefania touched on it. If you're looking at doing a first-time home buyer withdrawal of up to $35,000 per individual, you do need to repay this in the 15 years. You do have a 15-year time frame. They give you a leeway of 2 years after you do the withdrawal to start making your contributions back. But this is a great way to put money into your RSPs and get some tax sheltering. Don't ignore small repairs in your home. They can grow into bigger problems. So I know I keep going back to the rain and the roof situation and the leaking, but if things aren't taken care of, it could lead to mold and much bigger issues down the road. So really tackling them head on early is probably the best way to do it. And then if possible, consider renovations as a way of increasing your home's value. So, you know, we spoke earlier about pride in home ownership. And people today are definitely getting to see the value of establishing equity in their property. So if you had bought a property 10 years ago, you might just by owning that property have established a great amount of wealth just because the way the markets have been trending and looks to continue to trend. So adding renovations is always a great idea in terms of keeping up to date. Okay. And then that's it. We've come to the end. So questions?
Thank you for that presentation, both of you. Now we would pass it on and we would like to hear from you, our attendees. Please feel free to use the Q&A function to submit your questions for our guest speakers. I guess to kick off, if I may start off, since our audience is primarily young alumni, Kamal in our questions, the Q&A asks, what is the most strategic way to buy a home and pay off a student loan at the same time, especially if there's no money help from parents and family members?
So paying off your loan is definitely one of the one of the first things you want to do. Because when you do apply for a mortgage, we take into consideration all the credit that you're carrying and what your monthly payments look like. Now, if you have an income that can comfortably support both, then absolutely, you'll still get an approval in that sense. But again, it comes to your budgeting as well. So just because you have an approval, you have to ask yourself, is this something that I can actually budget and ensure that I'm paying off both at the same time and I will still be able to live comfortably? So to say you have to do one before the other, no, it's not necessarily true. It really depends on your own personal situation and what your income looks like.
Awesome. Thanks for sharing that. I think definitely it would be very case by case and based off each person's situation. I guess moving on to the second question, a few of our members in our audience are asking about the credit score. So how does one improve their credit score and how does it impact your mortgage applications?
Yeah, so I can take that one. So in terms of credit score, so it starts at 0 and it can go essentially up to anywhere around 900. And the higher the score, the better. So in terms of paying your credit before the due date, making sure you're not using the full limit on your credit cards, your lines of credits, making sure that you still have a little bit of space and you're not fully utilizing the credit limit is a good idea. Also making sure that you don't have a great amount of trades. So sometimes people will go into a mall and the Bay or Canadian Tire will be offering credit cards. And at first it seems like a great idea because maybe you'll get 10% off your purchase that day. But having multiple trade lines sometimes can get people into trouble in terms of using those cards, first off. But also just by having the credit facility open also shows that you're kind of getting to a point where you might be over leveraged or overutilized.
Thank you. I think that was very insightful. Moving on to what would you say, what is the top thing I should be or any of us should be doing to make the home buying experience easier?
Yeah, I would say start with a savings. Establish a savings pattern. Stefania touched on it earlier. If you're thinking of purchasing a property in the next little while, start putting that money aside right away. So if you get paid bi-weekly or monthly, making sure that as soon as you get paid, you're putting some of that money into a savings account that you're not touching. So that way, when you do get a mortgage, you don't have that sticker shock of, oh my goodness, where am I going to find all this money now to make my mortgage payments? You've kind of already weaned yourself onto it. That would be the first thing. The second thing is start thinking about what's important to you. So which neighborhoods are important to you and your family? Are you happy living in a condo? Do you prefer a house? Do you need a backyard for a dog? Start thinking about your lifestyle, what's important. Do you like to be able to have a car outside, or are you okay with public transit? These are big questions to be asking yourself. Where is your work? Are you able to work from home and you can maybe buy a property out in the country? Or do you need to commute downtown every day? Do you want to be close to work? So some key questions, and get to really know yourself and what you would be okay with.
All right. So if I understand correctly, it's pretty much based on each of our personal preference and what we want to do and what's important to us. And I guess speaking on savings, what would you say, what's the best strategy to save money for a down payment? Like, especially given that many of us are young alumni, how do we go about saving for the down payment?
Yeah, so, it's getting harder and harder, I think, to save for down payment as purchases or purchase prices just keep increasing. So maybe first thing is stay nice to your parents and hope you can get a gift. We do see a lot of refinances for customers wanting to give a gift to their children. So this might be an option to further support your ability to purchase. Another thing is, like I said, savings. So if you're working, make sure that you're paying yourself first. So I know that I'm going to need at least, I don't know, $10,000 saved this year. Then I'm going to work backwards and look to see how much that would actually accumulate or how much I would have to put away every 2 weeks. And when I get paid, then I'm going to automatically put it into that account. And then whatever I have left over, I can use to spend on my my extracurriculars, my groceries, that kind of thing.
Thanks. I think it plays. I think the whole self-discipline aspect comes in it as well too, and just budgeting and keeping yourself in check. I guess we talked about savings side. If I were to flip on the other side, based on like the current trend of mortgage of new homeowners, what is the average cost of a starter home?
Well, I guess, first of all, you'd have to think about the area, right? So certain areas are more affordable than other areas. I think the last article I read, the average home price in Toronto is now over $1 million. So, and that's just an average home. So that's something to consider. Like Michelle said, if you work from home and you don't have to do the commute, maybe looking at other areas that are a bit more affordable, maybe give you a bit more bang for your buck, more of a yard for that same price, more property, whatever it might be. Those are definitely things that you would have to look at. But again, it's, you got to narrow down the area and figure out, what am I okay with getting for the dollar that I'm paying?
Okay. I guess to follow up on that, I know there's no set stone numbers and each circumstance is different. Following up from that, like on average, how long are new home buyers taking to pay off their mortgages? Because some may be able to, depending on their situations, everyone may be different, but on average.
So normally we see people go the full amortization. And nowadays, I mean, with the prices being where they're at, the mortgages are obviously a lot heftier than they used to be. We do have people that pay extra, absolutely. And if you can, do so, right? If you can afford to put a little bit down on your principal, why not? You could get rid of it faster, but I can't say that I see a lot of people in a race to pay it off. I find that my customers that do start the race are usually within the $100,000 mark. They got only about 100,000 left. So now they're getting really excited to get it paid off. But the important thing is just buying now, getting, making sure that you're in your budget, and then going from there, because, you might not even stay in that house. You might end up, selling it at a later date for more money than what you paid for it. So yeah, so it really depends on the people, but yeah, so it would depend on if you paid extra to pay down your principal.
Thank you. And just going off of, if you want to call it the mortgage raise, some people want to get a head start, right? So Stephanie from the audience is wondering if there are any fees or penalties for putting down a large sum of a down payment to start off the mortgage.
Sorry, if there's any fees if you put down a larger down payment?
Yeah.
No, you can put down whatever you want for your down payment. But like I had mentioned earlier, if it's less than 20% of the purchase price, you will pay the CMHC fees.
Okay. Awesome. Another question from the audience, Anna from the audience asked, what is the difference in getting a mortgage from a bank versus private or third party, or using a broker that reaches out to multiple mortgages? What's the difference in that?
So there's different types of lenders. Banks are usually what we would consider to be A lenders. So we give the best rates. We have a lot of flexibility in our products. Then we go on, then there's B lenders, and then there's C lenders. And what happens there is you might see higher interest rates. You might see more tied in details to being able to break the mortgage. You might have a lot more penalties in that sense. A mortgage broker, dealing with a broker, they'll actually look at all different types. They'll look at banks, and then they'll look at B lenders, C lenders, depending on the customer situation. So they might be a bit more lenient than, say, an A lender, but it definitely comes at a cost.
Okay. Got it. I guess based on your experience, is taking out a line of credit advice? And if so, how do we do this, and how are you evaluated for the line of credit?
Yeah, so there's two different types of lines of credit. There's an unsecured line of credit, and there's a home equity line of credit. So an unsecured line of credit, as the name mentions, there's no security. A home equity line of credit is secured with a property. So if you're looking to make a purchase, you have the option to either do it with a mortgage product or a home equity line of credit. And an unsecured line of credit, because there's no security, typically it's for a lesser amount and a higher interest rate. So sometimes people will take it so that they can have a little bit of cash on hand in the event that they need to make a deposit, and they don't have the savings readily available in their account. But if you don't need the, or you have a little bit of savings established and you have the money for the deposit, it's not advised that you do an unsecured line of credit because it looks like a trade line on your credit bureau, which we're going to be incorporating into your debt ratios with your mortgage approval.
Okay. Awesome. I think that was very helpful as well too. And just moving on, I know you've touched on this in your presentation, but when you sell your home, what happens to the mortgage at that point?
Yeah, so there's a couple of things that can happen. So sometimes you will have the cash and you can just pay it outright. That's the best option. Another option is you take your mortgage with you so you can port it. So say, for example, you're selling your property, but you're purchasing another. You can actually have the option to port the mortgage from one property to another, as long as the amount that you require is the same or greater. And then there's also the option to transfer your mortgage to another bank at that time as well. But your lawyer and your bank will tell you of discharge amounts and fees to go with that, with any of those transactions.
Okay, awesome. And jumping back to the beginning, sorry for going back and forth. I know this then, if I were to go back to the beginning of the whole process, Adriana from the audience is wondering, what happens if the interest rates go down after you get pre-approval? Can you take advantage of the better interest rates?
Yes, we can definitely adjust the interest rates on a pre-approval deal if it's gone lower.
Awesome. And back to the, I guess, credit score aspect. Do you mind explaining how the credit score can impact your mortgage applications? I know we talked about how the scores move around and what we can do to make it better, but how does that play into the whole mortgage application process?
Yeah, so for example, if you have a bankruptcy, that can significantly impact your credit score, or a consumer proposal, both of them actually significantly impact your score. And if you have one of those situations, or even if you have collection items, R9s on your credit bureau, that may hinder your ability to be approved with an A lender, and you may have to go with a B lender or a C lender or a private mortgage. So it's really crucial to have the best, cleanest credit possible, so that you have more options in terms of who you can actually get a mortgage with. And it's been known that typically if you're going with B, C lenders or even private, because they are aware of the situation that you are, I don't want to say desperate, but almost are, in terms of getting qualified, they may charge you higher interest rates. So really having clean credit is good in getting you the ability to be approved anywhere you like, as well as better rates.
I guess just to go off of that, we have a more specific question, but it may be relatable to quite a bit of people in the audience. The question is, my parents have a mortgage right now. If we want to sell the house and me and my brothers will be buying a new house and will be considered as a first-time buyer, is it better to do that rather than having a second mortgage?
So I think it depends. Are you already on the existing mortgage? If you're not, you need to really look at overall relationships. So if I was living at home and me and my siblings and my parents were looking at purchasing a property and we do so, and then, for example, I want to move out and purchase a property on my own, well, am I going to be able to qualify because I'm still going to have the debt of my parents' mortgage on my credit bureau, or vice versa? Do my parents want to qualify for their own mortgage, but now they're stuck to my mortgage? So always keep in mind, when you're co-signing or going on an application, even if it's not primarily your debt, it will show up on your credit bureau as a trade. If that person that says they're going to pay for the loan or the mortgage doesn't, even though you may have made a personal agreement with them that it was their debt, it will still impact your credit score.
And something I just want to add to that is if you are on the existing mortgage with your parents, you then, when you go out to buy your own, you won't qualify for any of the first-time home buyer tax credits or advantages like that. So that's something to be very cognizant of as well.
All right. I guess just to go off of that, what are some considerations with purchasing a property with a partner or family?
So I think just pretty much what I just said in terms of, you know, applying for a mortgage is looking at your credit. It's a snapshot in time. So your income today, your relationship today, your employment. So there's a lot of things that we're looking at right now, and you have to kind of be prepared for down the road what might happen. So me and my sister want to buy a condo together right now. You know what? I want to move out with my boyfriend. Well, when I go to apply for that mortgage with my boyfriend, I'm still going to have the mortgage with my sister on my credit bureau. So really starting to think not just about the right now, but maybe in a couple of years, what are my plans? A mortgage is a big commitment, and there can be big penalties if you're paying it out prior to the end of the term. You want to go in prepared, knowing that there are fees in the event you're breaking your mortgage early. And in terms of consequences in looking for applying for credit and not qualifying because you've taken on additional debt.
Okay. I guess just stepping back, I know we discussed a bit about mortgages and a little bit of line of credit. What's the difference between the home equity line of credit and a traditional mortgage? Any benefits for consideration over one or the other?
Yeah, so a home equity line of credit, as you pay down your line of credit, then the funds become available to you again. Whereas a mortgage is a fixed term loan. So it might be actually easier to qualify for a mortgage because when you apply for a mortgage, the bank knows you're always going to be decreasing the amount of debt and exposure that you have with them. Whereas a line of credit, say for example, I have $1 million line of credit on my house and I've paid down 500,000. Well, I now have 500,000 at my fingertips to maybe do renovations. Maybe I want to pay off my student debt. Maybe I want to start thinking about saving for potential children's education down the road. Maybe my vacations. The rates on a home equity line of credit are significantly better than an unsecured or on your Visa. Visa rates can be, or credit card rates can be 21, 22%, 26, where a home equity line of credit is comparable to a mortgage in terms of rates. So really looking at how can I maybe make a car purchase without getting the financing through the dealership? I can use my home equity line of credit. So it's really about using the equity in your home to finance. So you're kind of your own bank.
Awesome. That's very helpful. Thank you. Just going back to some of the costs. Are there any hidden? I know we talked about some of the costs, but are there any hidden costs when buying your first home? And how do we sort of keep an eye on those?
So going back to the presentation, it's not so much of hidden costs, it's just costs you need to be aware of. So you have your closing costs, you have your legal costs. Like I said, you need a lawyer when you purchase property. So you got to pay them. Then you have your home inspection fee. You have your land transfer tax costs. You have any moving costs. Those are all fees that you have to factor in when purchasing a home. Then there's, if you buy a condo pre-construction, you could be paying the phantom rent for a certain period of time until they actually register the property. And these will all be outlined if you do purchase pre-construction. It'll be outlined in your package. And that's something you want to go over with your lawyer with a fine-tooth comb so that they can tell you where any potential fees could get you after. So that's something, a really big recommendation. Whenever my customers come in and they're buying a condo, the first thing I tell them is make sure you went through this with a lawyer, because that's where you could potentially find some hidden fees that you weren't aware of. But generally, when purchasing a resale property, those are the ones you want to think about, is the land transfer tax, your legal costs, as well as your inspection costs.
Awesome. And going back to the monthly payments and mortgage, is there a possibility that you could pay more than your monthly mortgage loan payment so that you can pay off your mortgage at an earlier date? And is there any consequence to that or benefit? And would you advise this type of strategy?
So it depends on the lender, on who you took the mortgage with. We can speak on behalf of TD because we know TD's policies. TD has a lot of flexible prepayment policies. You can actually double up on your payments with no penalty. So if your regular payment for your mortgage is $1,200 a month, you can pay $2,400 with that additional $1,200 going all to principal. Now you don't have to pay all the way the 100%, double up the entire way, but you can go up to $2,400 or whatever the double up amount is. As well, on top of that, TD offers you the option to pay 15% of your original borrowed amount on an annual basis. And all those funds will also go directly to your principal.
Awesome. Well, thank you so much to both of you for taking out the time to join us and share your knowledge and insight. As our last question, we want to give you both an opportunity to share any last words of wisdom or advice for our young alumni who is going through the process of purchasing their first or even second home.
So one thing I would say is budgeting is key. So I spoke about it in the presentation and I really, really mean it. I think knowing what you're going to get into and what your lifestyle is going to change, how your lifestyle is going to change is something that's really important. You need to ensure that you're still going to be able to pay off, this debt. Granted, it's a great debt to have because you're getting a great asset with it, while still living comfortably. That's the first thing. And then the second thing I would say is, if you decide, okay, it's time and you have the funds, you've secured, you're ready to go, don't wait. Don't try to time the market. If you need a home, you need a home. Get it. No good. You don't know what's going to happen with the market. There's no point in trying to time it. And really, at the end of the day, you're going to be left with an asset, which is your property. So why not just jump in if you're ready for it?
Anything else to add, Michelle?
Yeah, I think my last thought I'd want to leave everyone with is it's never too early to start saving. Even if you're not ready to make an offer on a home today, it's never too early to start saving, because as prices go up, deposits and down payment amounts will also go up. So whenever you can start.
Awesome. Thank you to both of you. And thank you to our students, alumni, and friends for joining us. I guess we have a question for our audience now. Please answer in the Q&A box. What aspects of today's event did you find most meaningful or helpful? This really helps inform our events moving forward and how we can tailor them for you. Feel free to share today's talk with your friends. It will be posted on our York Alumni YouTube channel. You may also join our LinkedIn group or follow us on Facebook by searching York University Alumni, and follow us on Instagram and Twitter using the handle YorkU Alumni. Feedback about this or any of our other programming is welcome and can be sent to us on our social channels or at alumni@yorku.ca. Also, York's Top 30 Changemakers Under 30 program is currently accepting nominations. The Top 30 program aims to recognize inspiring and diverse alumni aged 29 and younger who are driven to make a difference locally and globally. You can nominate a York grad now until October 31st. For more information and info on how to nominate, visit alumniandfriends.yorku.ca. Thank you all once again for attending today's event. Our next gratitude session is our last speed networking session on November 25th. Event registration is now open, so please visit alumniandfriends.yorku.ca if you'd like to attend. We look forward to seeing you there. Wishing you all continued health and wellness during the time.